let's focus on the real estate and the real estate funds. Real estate funds, to compare that and differentiate it from the hedge funds, is you need to be investing actually in real estate. And with both the hedge funds and the real estate funds, we're always worried about the Investment Company Act exemptions. For the hedge funds, the most common exemption is you have less than 100 investors. And that's also where you get companies that keep doing fund after fund after fund, keeping all the funds underneath the 100 investors. Real estate is far easier because real estate itself is an exemption from the Investment Company Act. And we absolutely try to avoid the Investment Company Act because then you basically have to go public. And like I said, it's an exempt. We don't have to deal with it as long as you're investing into real estate or first lien debt, mortgages, second position liens, or buying into other syndications. Under the eyes of the Investment Company Act, the eyes of the SEC, that is still making securities and investment type transactions that are not related to real estate or doesn't have that security that a real estate will. With most real estate funds today, we still have been seeing there's a preferred return, which is kind of like an interest rate that's get paid out. And then there's a profit split, usually a 50 to 60% profit split to the investors and the remainder going to the sponsors and the operators. Now, what we are going to see more of, and it's definitely happening now already, is to do away with the preferred returns and just see a straight profit split, where the profit split may be 75 to 80% to the investors, but there's not that preferred return, that interest rate up front that has to be hit before the division of the profits. And I'll tell you the reason why we're seeing a lot of these changes. Well, it comes down to the interest rates. And as the interest rates have gone up, cash flows have gone down, the cost of capital has gone up with the banking costs, carrying costs. It does get to be more difficult to get over the preferred return rate to get to that profit split. And one of the biggest reasons why you're here and why we do real estate funds is it's not about just the fees. To a large extent, it's about the profits at the end of the day, but also the profits during the operations. And if we can give a higher share of the profits and do away with the preferred returns, it looks that much better. And I will draw a parallel to, I set up quite a few different hard money loan funds back in 2009 to 2011 timeframe, and we had higher preferred returns at that point. We're also getting interest rates on the hard money loans up at 15%. As those interest rates came down, got compressed from 15% to 12 to 10 to 7, it became impossible to hit the preferred returns and the splits that would make sense for operations. And it frankly started to implode some of those opportunities. Now, those same guys, they just wound down those funds, restarted new funds, did away with the preferred returns, and are now just offering the profit splits at a higher profit split rate. And so they're guaranteed if a dollar comes in, they're at least keeping 20%. So that's been a big change. We're seeing that happen again as the interest rates are adjusting. So if you're thinking about doing a real estate fund, that's definitely something to take into account at this point. And in terms of the management fees are often the exact same as a real estate syndication. And we'll share kind of our summary of real estate fees for everybody that's on this webinar, make it available for anybody that's watching. But the different but easy synopsis is there's usually buy and sell fees. Acquisition and disposition fees is what we refer to those as, 1% to 2% usually. Then there's usually an asset management fee. Again, 1 to 2% of the income of the rents as it comes in. Now, other fees that may be involved are property management fees. Asset management fees are your services to the fund. Property management fees are your services to the property. You may hire a third party to do that. You may do it yourself. Or real estate development or construction fees. Sometimes you hire somebody else. Sometimes you do it yourself. If you as the management are providing these services, we just need to disclose what you're going to be charging. And as long as it's relatively reasonable within the markets that you're operating, you're in a good position. Now, I do want to draw a difference. We're seeing more and more, I'm going to call it a vulture fund. But because a lot of these multifamily projects and larger real estate investments are having difficulties because of the increased cost of the loans, with the interest rates going up, there are these vulture funds coming to save the day or loan to own because they're making some high cost investments under the guise and with the idea of we're going to save your opportunity. But the reality is at the end of the day, they're there to make their as much money as possible, potentially take over the entire deal. Most of these are actually not investing into real estate. They're investing into the securities. So it brings up all of those same considerations that I brought up previously with the hedge funds and those types of structures. And then finally, we have REITs. And I really want to explain a REIT because so many people don't understand what a real estate investment trust, a REIT, actually is. And just to be clear, a REIT is, oddly enough, generally a C corporation that elects to be taxed as a REIT. They're most favorable for cash flowing investment opportunities. And the reason why they're best for cash flowing opportunities, there's generally capital gains from the sales, but there's not a pass through a depreciation like there is with partnership funds or most syndications where it says, oh, I got this bonus depreciation. That doesn't apply in a REIT. However, it really simplifies the tax preparation because it allows you to just send out a 1099 for all of the various distributions and dividends that were actually paid out. It makes life a lot easier from the tax preparation standpoint. But biggest thing is you lose out on the depreciation. And I always get this question, where does it go? Because it's a C corporation, the corporation itself holds on to those losses. And when the REIT dissolves itself, it equalizes with the sale of the property. Instead of having the tax, the depreciation recapture, where, hey, I made $100,000 investment, I depreciated and wrote off $200,000, I sold the property, now I got to take this phantom $100,000 gain. It all stays at the corporate level rather than you individually own. So I can go a lot deeper into it. One of the biggest things about with the REITs is, at least 75% of the assets have to be real estate, and at least 90% of the income has to be distributed. But it's taxable income, so that depreciation that often would generally come to you through a K1 stays at the corporate level. It decreases what has to get paid out. And that's a secret how a REIT continues to grow.